That seems like that's new thinking, at least publicly being talked about new. So in that same era, or in that same vein, if you will, President Barkin, is the Fed flexible when it comes to the target on inflation? Is that 2% maybe not attainable? Maybe there's a new natural level of inflation. So how does all of this new thinking around the new framework about what is appropriate and what to think about?
So for listeners who may not be as close to it as you and I are, we do have a framework that talks about how we do monetary policy. Bernanke started in 2012. The core element of that framework is actually a 2% target. The 2% target was not defined specifically and announced publicly before 2012. We all think in central banking, it's very good to have a target. It helps build credibility that people believe you're going to do what you said you're going to do, as opposed to, yeah, there's some level and we sort of think about it and we'll just judge it at the time. So that commitment to the target, big deal. And this most recent update did not change that in any way. And so, we talked about a 2% target, we committed to it. I don't think there's really much doubt about that in and around the committee. The big change was, interestingly, 5 years ago when we last looked at it, we were under our 2% target and had been for 10 years. And so there was a lot of conversation about what do we need to do to get inflation back to our target from below. Today, of course, we're thinking about how do we get inflation back to our target from above. I'll just say one more thing. It really helps us to get to 2% if the world knows that we're committed to 2%. And so, if you're in business as I was for a long time, and you're setting prices for next year, and you say, what do I think inflation will be a year from now? The notion the Fed is committed to 2% is helpful to manage your expectation toward 2%.
So again, it's about certainty.
It's about clarity, certainty, predictability for both consumers and businesses in the marketplace to able to set their expectations.
Does this framework and the thought about how the Fed approaches this new framework, does it change the balance between the dual mandate between full employment and stable prices?
Well, I think we've in the framework that we worked on 5 years ago, we talked about our willingness to do a moderate overshoot of inflation over 2% for a short period of time to bring expectations back up to 2%. We've cleaned that out of the framework. It feels like it's not really connected to the environment we're in today. And so we've just been much simpler. Our target's 2%. We do our best to balance the tools. And if we get in a situation where those things are in conflict, we'll take a balanced approach to try to bring it back.
Let me just talk about tariffs for a second. Are you beginning to see the manifestation of tariffs in prices now?
Yes, we are, but maybe I'll distinguish prices from inflation. So I talked, as you know, I'm in the district constantly. I was in Greensboro on Wednesday. I'm in Charlotte today. You're talking to businesses about what they're doing with their prices. Those who are subject to tariffs, of course, are doing their best to pass it on, whether it be to intermediaries or retailers or end consumers. And so it shows up in the price. Consumers then have a choice, which is, do I want to pay that price or defer a purchase or switch to private label or maybe switch to somebody else who's not increasing my price? And so that thing is going on all the time. So businesses are taking whatever tariff costs they've got and they're doing their best to minimize that impact. But what's left over, they're definitely passing on in prices. But in inflation, there's this dynamic where consumers sometimes are paying the prices and sometimes are not. So you're seeing in the inflation numbers, modest, I'll call it, impact of tariffs. You're not seeing, huge impact of tariffs. And I think that just comes down to where the consumer is right now. I mean, we're not in 2022 anymore. If you go back to 2022, policy was accommodative. Consumers had money, whether it was repressed COVID savings spending, or it was stimulus payments, or it was frothy asset markets. And frankly, we were ready to spend, or we were ready to revenge spend, which was the phrase at the time. And so costs went up, people raised prices. You didn't like it, but you paid it. The consumer today is in a very different frame of mind. I mean, we are seeing big increases in people shifting from full price retailers to value retailers, from brand names to private labels, from beef to chicken, from vacations to staycations. And what that means is you're seeing price elasticity happen in action. And so I don't think it's as easy as to say, my costs are going up because of tariffs, I'm going to pass it on and people are going to take it. I think the consumer's making choices, and that's limiting the impact on inflation.